All right, if you're in banking or you run a business here in Nepal, there's no way you've missed all the talk about the new working capital guidelines from Nepal Rashtra Bank. I mean, they've completely shaken up the world of business lending. So the big question is, what do these rules actually mean for you and your business? Well, that's exactly what we're going to unpack. Let's get right into it.
So first things first, why did we even need this new rulebook? It's a fair question. To get the answer, you really have to look at what things were like before these guidelines were put in place. And let's just say the system had some pretty serious challenges.
Before these guidelines, the lending scene was kind of like the Wild West. Seriously, every single bank had its own way of figuring out loan limits. This inconsistency made it incredibly hard for the central bank to keep track of where all this money was really going. There was a huge risk that funds meant to, say, buy inventory were being used for something else entirely. And all of that adds up to a massive credit risk for the entire banking system. So yeah, NRB knew it had to step in and create one clear rulebook for everybody.
And here it is. This is that rulebook, the Unified Working Capital Guidelines from 2079. They were built to be the single, standardized roadmap for everyone to follow. The whole point was to bring order, transparency, and probably most important of all, a whole lot of financial discipline to business lending in Nepal.
Okay, so how do we actually use this new roadmap? Well, the very first thing you need to get your head around is that not all loans are created equal. The set of rules that applies to your business depends completely on the size of the loan you're after.
The whole system is basically broken down into 3 different tiers. For the smaller loans, we're talking up to 1 crore or a bit higher at 3 crore if you're a manufacturing business. The guidelines don't even apply. Banks just follow their own internal rules. Then you have this middle range, from 1 up to 2 crore, or up to 4 crore for manufacturing. Here, a sort of simplified version of the guidelines kicks in. But for any loan that's over that 2 crore mark, or 4 crore for manufacturing, well, that's when the full, detailed, mandatory set of rules takes over.
And this is where you can really see the split in the road. For those mid-tier loans, the math is pretty straightforward. The bank's going to look at your projected sales for the year and basically offer you a limit that's about 20 to 50% of that number. It's a faster, simpler assessment. But the moment you step over that line into the bigger loans, whoa, the game completely changes. We're talking a deep dive analysis, a lot more paperwork, and crucially, you have to break down your working capital into 2 totally different buckets. This brings us to one of the most important new ideas in the whole guideline, at least for those larger loans. It's this concept that not all working capital is the same. It actually has 2 different faces, one part that's permanent and another part that goes up and down.
So first up, let's talk about permanent working capital. The easiest way to think about this is like the foundation of a house. It's the bare minimum amount of capital your business needs 24/7 all year long just to keep the lights on and maintain a base level of inventory. Because this is a stable, long-term need, the guidelines say it should be treated like a term loan, something you pay off over 3 to 10 years.
And then you have the other side of the coin, fluctuating working capital. If the permanent capital is the foundation, think of this as the seasonal decorations you put up. It's the extra cash you need for that big Dashen sales rush or to handle a massive one-off order from a client. Since this need comes and goes, it's structured as a 1-year, renewable revolving credit line.
This chart just makes it super clear, doesn't it? You've got that solid, stable base of permanent capital, that's your term loan, and then layered right on top, you have your fluctuating capital, the revolving credit that expands and contracts with the natural rhythm of your business. Add them together, and that's your total working capital limit.
Okay, let's get into what is maybe the most technical and most talked about part of these new rules, the variance analysis. This is basically NRB's built-in reality check to make sure loan amounts stay connected to actual performance.
So here's the core idea. Businesses make projections to get loans, but what happens when those projections are way off? Well, this rule says that if your actual audited sales are more than 20% lower than what you projected, then your loan limit for the next year has to be adjusted downwards. It's a system of accountability.
Let's make this crystal clear with an example straight from the NRB circular itself. So, imagine a business projects a turnover of 5 crore for the year, but when the year ends and the books are audited, their actual turnover was only 3 crore. Now for the next year, they're feeling optimistic and projecting 7 crore. First step is to calculate the variance. The formula is pretty simple. Actual sales minus projected sales, and then you divide that by the projected sales. So in our case, that's 3 crore minus 5 crore, which is negative 2 crore.
Divide that by the original 5 crore projection, and you get a negative variance of 0.40 or 40%.
Now, because that 40% variance is way bigger than the 20% trigger point, an adjustment is mandatory. And NRB gives us this very specific formula to calculate the new loan limit. Essentially, it takes what your normal limit would have been and then shrinks it down based on how big your variance was.
Let's just plug in the numbers and see what happens. Normally, with a 7 crore projection, the limit might be 20%, which is 1.4 crore. But now, we have to apply that adjustment factor. We take our 40% variance, cut it in half, that's 20%. So the eligible amount gets a 20% haircut, and boom, the new adjusted loan limit drops to 1.12 crore. It's a perfect example of how your past performance now directly and mathematically impacts your future funding.
So we've covered how the loan limits are set. Now let's talk about another huge change, the rules around what actually secures the loan and how banks have to keep an eye on things.
The new guidelines are super clear on this. For a working capital loan, the main or primary security must be the current assets of the business itself. And what does that mean? It means the very things the loan is paying for: your inventory, your stock of goods, and your accounts receivable, which is just the money that your customers owe you.
Now this is a really big deal. It's a landmark shift in thinking. The guidelines explicitly say that fixed assets, things like your land, your office building, your factory, are not to be taken as the primary security for working capital. The whole point is to move away from lending based on how much land you own and towards lending based on the actual health and cash flow of your business operations.
And to make sure everything stays on track, the monitoring rules are pretty strict. Banks have to physically inspect your inventory and receivables at least once every 3 months. All your sales revenue has to go into your official company bank account. And you can only use the loan funds directly from the loan account for actual business expenses. There's also this interesting cleanup rule, where for at least 1 week a year, you have to bring your loan balance way down, just to prove you're not permanently living on the full credit line.
Okay, so we've gone through all the details, the tiers, the 2 types of capital, that tricky variance analysis, the collateral rules. Let's just zoom out for a second. What's the big picture here? Why does any of this really matter?
Well, the goal is really 3-sided. For businesses, it pushes you towards better, more honest financial planning. You can't just pick a big number out of thin air anymore. Your projections now have real consequences. For the banks, it creates a level playing field. Everyone uses the same system, which makes lending more transparent and a lot less risky. And for Nepal's economy as a whole, the main goal is to build a much healthier credit culture, one where money flows to productive businesses that are actually growing instead of just getting lost in the system.
And that really leaves us with a final question to chew on. These rules are all about discipline and managing risk, but will they be the catalyst that sparks real, sustainable growth across the country? Or will they end up being a bureaucratic headache for agile, fast-moving businesses that need to adapt quickly? I guess only time will tell.